it doesn't really matter whether the Fed raises or lowers rates. It matters what the market thinks the Fed is going to do.
Hey everybody, Jaysen Barlow with Sell for 1%. I'm joined by Rich Cercone of Equitable Mortgage and Dave Barlow and Jaime Barlow of Sell for 1%. We're here with a market update in 20 minutes. And Rich, what is going on in the marketplace?
Well, how you doing, fellas?
Great.
The market, we had a little bit of a pause in the upward pressure of interest rates on Friday because of the unemployment number and the jobs creation number being slightly weaker than expected. If we remember, right? That's good news. The two things the Fed is looking for is inflation, and they want to see that under 2%, and they want to see that they're still creating jobs and that they've, that the jobs are in a stable state, homeostasis state. And on Friday, the little bit weaker number is good news for interest rates, even though it's bad news for people looking for a job, because, that means that that's a little weaker economic data, which leads to needing more stimulus possibly. But the biggest thing is the Fed is focused on inflation, and they want to see inflation 2% or less. And there was some talk, well, maybe they'll go to 3%. Maybe they'll, ease that up just a little bit. And Jerome Powell again reiterated he's looking for 2% in inflation. And until he sees that, he sees no reason to start lowering rates. So we don't have any path for lowering rates. There's even been some talk in the last week or so about raising rates possibly as the next step. So there's a lot of uncertainty in the market right now, but none of it really, besides a slightly weaker employment number, is leading to a path towards lower interest rates for mortgages. And that's where we are.
If you were to put on your Karnak, I don't know if any of you guys remember the great Karnak on
Just that where he'd hold up the letter like this. Remember that, Dave?
Yeah. And then he'd make his prediction of what was in the envelope, and then would open up the envelope. So for your great Karnak impersonation, where do you see interest rates in 30 days, 90 days, 6 months from now? And I'm putting you on the spot. I know that, Rich, but, what do you think? What's your gut telling you?
Well, for what it's worth, for this, humble prognosticator, I don't see anything in the next 30 to 90 days. I don't see anything that's going to happen that's going to impact interest rates much in the next 30 to days throughout the summer, we'll just say. As we get closer to the election, it's hard to say what forces may be at play, political, geopolitical, all those things. But I'm starting to be very dubious about the idea that the Fed will actually lower rates in 2024. I mean, we're over a quarter into 24. We have no timeline about a rate cut, and I just think we're getting into an election situation now. I think that they're going to take a pause and just watch what happens and revisit all this in 2025. That's kind of my feeling right now. Now, remember, though, that it doesn't really matter whether the Fed raises or lowers rates. It matters what the market thinks the Fed is going to do 6 months, 3 months from now. Right now, they don't think the Fed's going to lower rates, and that's why mortgage rates are staying higher. The moment they think that there's a rate cut coming in the next 3 to 6 months, mortgage rates will go down immediately at that point.
So that's why I think that they have strung us all along with transitory and soft landing, and they, it was going to be 6 rate cuts. Now it's going to be a rate hike. So I think part of the game is keeping everybody happy and don't tell them what the truth is of how bad it really is.
Right. But I'll say this. everybody wants to pick on the Fed, but to this point, they have not crashed the economy. We thought everyone thought conventional wisdom was if they start raising rates, we're going to see a recession. We have not seen a recession, and at least, according to the numbers. And so to this point, they're managing the situation fairly well. They're keeping the economy at a steady pace, and they haven't crashed anything. Everyone was talking about a hard landing if they start to raise rates. So they've managed it. I guess we've got to figure they know what they're doing and see what tomorrow brings, basically. But for the folks out there, if you're wanting to buy a house, you got to put a 7 in front of your mortgage rate for the most part. It's going to be 7.25.
What is that? What is your current range?
I would say that the mean interest rate right now, because we always talk about there's not one rate anymore, about 7 1/8 or 7.25. That's great credit, good loan to value. Now, again, higher loan amounts carry a higher rate. Lower loan amounts, 150 or so, you're going to get a better rate. You might be in the 6s on something like that. So we could see a rate in the 6 3/4 range, and all the way up into the mid to high 7s if your credit scores and other factors are not quite as good as you want to be.
And so would it be fair to say that you would expect interest rates to kind of hang in that 7.25 range or thereabouts over the next several months?
I do. Yeah, I think that's where we are. Yeah, I think
so. The new norm.
And the new norm, which kind of is the old norm from the end of last year,
exactly.
Is, you're looking at 7s, and there'll be a point a year, 2, 3, 4 from now when we'll see 5s and maybe even 4s. So buy the house now, because it's 7s, could be 8 or 9. You don't know. But, at some point, rates will go down and you'll be able to refinance. But if you wait for rates to go down, everyone else is doing that too. So you're going to pay an extra 10% or more for that house that you want to buy. So buy it now.
That was a long discussion we had yesterday talking about, do you go ahead and just dive in? I mean, it could be worse. I mean, it could be as bad as Jaysen thinks it is, and it could be 18%. Don't worry, it will get worse. Well, then you better buy now, lock in your interest rate, and then you'll be happy in 3-4 years when the house is worth another $100,000 and you're not paying that with a high interest rate.
Right.
That's why I look at it, but call me crazy.
You have to, every family has to look at their budget. That's right. That's important. And, it's something we've been around long enough and we can't dismiss that. So, if 7.25 and such price equals a mortgage payment that your family budget can handle, I'd say buy it. If it's out of your budget range, then, you need to get some financial advice and figure out how you can get in pace with the market. Because I don't see the market prices going down anytime soon, or anytime really in Columbus. I don't know whether I'll ever see that in my lifetime at this point.
I'm sorry, you were saying about interest rates or house prices, or both?
House prices. I don't. Some house prices going down. Yeah.
I don't disagree with that. I just there's a real lack of inventory, and the pace has slowed. We looked at numbers yesterday. 2 years ago, appreciation in the Columbus board was 23% overall. Right now, it's about 5% overall. And of course, you have some areas that are hotter, some are a little less to get that average of 5. But I don't disagree. I don't, unless there just becomes a glut of houses on the market like there was. I think we looked last at the stats. Was it 2011? We had 15,000 house differentiation from the number of homes that were listed to the number of homes that were sold. Last year, it was a little less than 4,000 houses different. So if that continues, which I don't see any reason why not, Columbus Housing Authority says another 200,000 people, or we need 200,000 houses between now and 2030 to meet demand. MORPC says another 750,000 people moving into the Columbus Metro in the next 20 years. Where are they going to live? We don't have enough housing units. They can't build them fast enough. You're going to build 30,000 housing units. That can be apartments, condos, single family, whatever. You're going to build 30,000 a year to meet demand. That's not happening. So
I think what you're pointing to there, Dave, too, is somebody who's been in real estate in markets where it was not liquid. You could not sell a house in 29, 10, 11. It didn't matter what you had. There was nobody interested in buying your house. So it's a much less risky investment now than it used to be back in those days. You can buy something and change your mind in a year or two and sell it and probably make a profit. And you can sell it quickly, where there was a point where, I had some real estate back in 2008, 9, and 10. I could not sell it. I just was sitting on there and just writing a check every month for something that I didn't even want. So, it's a very liquid investment compared to days past. You can buy it, even make a mistake and get rid of it later and make money.
Yeah, I was in 2 listing appointments this week. Now, they're more expensive homes, but the one house was bought 3 years ago for $520, and we're going to list it for $700. So, there's $180,000 of appreciation in 3 years. And the other house I was in yesterday, they had bought for like $365, and I told them I thought we could get them close to $500, and they about fell out of their chairs. They were like, we were not expecting that. We would have been happy like at $450. It's like, well, this is what the houses are selling in your neighborhood. So those appreciation values I think is going to continue. We just don't have a glut of homes on the market like we did back in 2009, 10, 11, 12. There's far fewer homes on the market. So, all right. Jay, you got something to say there?
Nope. I disagree. We'll see what happens. I don't know that Columbus is going to, when you talking about those numbers, that's when it should become, to me, kind of alarming that that's not normal to have a home go up that much that fast. And, I don't want to get into all the different nuances and details, but it's like, I think the rates going up will impact affordability, and we will see something change, but who knows? Maybe I'm wrong.
I think we had this conversation about 15 years ago about Hilliard Green, didn't we?
Who knows what you're even referencing?
All right. Well, thank you, Richard. Good conversation. Jamie, you awake?
Yep.
All right.
Listen.
Thank you, guys. Thanks for having me again.
All right. Be sure to hit that like and subscribe, notification bell, all that good business. Get these updates once a week. And, Jay, I think we did make it under 20 minutes today. So, looks like about 14 minutes. So, not bad. Take us on home, would you?
If you like the content, leave a comment below, like, subscribe, ring the notification bell. You'll get notified when we crank out 50-minute market update videos. You can be the first one to know about what is going on. If you have any questions about buying, selling, financing, interest rates, Federal Reserve, market collapse, give us a call. Numbers in the description below. We will, on the buy side, the sell side, the financing side, you got, probably 100 years of experience sitting here. And so we're more than happy to answer any questions you guys have. Thanks for watching, and we'll see you next week.
Thank you.